Hello and welcome to FTSE Funds and Finance, the straight talking podcast brought to you by Goodwin Financial Services. We have a different sound setup this week, and I'm joined once again by financial advisor Steve Goodwin and Josh Goodwin. Gentlemen, how are we?
All good, thank you.
All good, thank you.
So, slightly different sound setup, first of all, just to address this of we're holding microphones today and we haven't been in others. This isn't the full setup, this is the halfway house, but we had a few people mention about the sound, so we've taken steps to address that.
Exactly. So we want to deliver a good podcast that people are happy listening to.
Okay, so let's start off with the financial news across the world, midterm elections in America. What does that? Most people might not be watching this in the UK, but what does that mean for the UK and the global economy?
Right, so this is very important. At the moment, the final results are not in. What's happened politically is that Trump has put a lot of his candidates across America to try and the Make America Great and rigged election mantra. And he's not been successful at all. So what it does mean is the Trump presidency run is definitely under threat now. And Joe DeSantis is more likely to get the Republican nomination. But more imminently, and what I'm hoping for, is that the Republicans get control of Congress. Now, why does that matter? Well, it matters because Biden then can't do anything. And markets love it when there's stability and they can't get anything through. So some of Biden's more radical proposals will just be rejected by the Senate. And that then means you'll have a year when nothing happens. And that's great for stock markets. Mm-hmm. And it will help the tough times that have gone through. So based on this happening, this should help us during the next 15 months, which is what I predicted back in March this year. So that this will help. And it's also seen in the last week, American markets have risen, and that is because of this. That is because they're foreseeing Republicans getting a majority. Now, if they don't get the majority, then it will destabilise stock markets a little bit. But they are now expecting that to happen, and therefore we've seen asset values rise in the last week or so.
Okay, and Josh, have you seen what difference does it make in terms of the clients you're speaking to? Is the American election, is it something people are talking about, or is it something more that financial advisors are keeping an eye on?
I'd say it's more something financial advisors are keeping on. I'd say the average client doesn't really take much interest in the US midterms. But yeah, something we need to keep an eye on to see how the market's going. Anything that's going to change, we need to keep in mind.
And as we mentioned before, if the American market coughs, we sneeze. So it's that close, and that's the reason why, obviously, you guys and us are keeping an eye on it, basically, yeah?
Yeah, no, exactly. The whole world economy is so closely linked nowadays. Something that happens in the US or Europe can have a big effect on everyone.
Bit of bad news for the British market in that Gavin Williamson has resigned this morning. It doesn't give Sunak's judgment a good look. That he's brought him in when this was hanging over him. So that doesn't help the Sunak bringing stability to the UK market. And the UK market won't respond well to that because it does undermine Sunak a little bit. And Sunak is supposed to be the steady ship. So a slight negative in the British market this morning.
How much of an impact do you think that will have?
Well, the British market is very, very precarious position, especially after Looney Liz got in. But now you've got the situation with Sunak that everybody's thinking safe pair of hands, reliable judgment, and the judgment's being called into question. So now he's gone, there'll now be a push on Braverman, and that isn't good. We just need some stability in the UK. But obviously the most important thing is the US. The UK is a very small part of our clients' investor portfolios, and that's not advice to anybody else, but I'm just saying that we don't overplay the UK market. And the other thing is also to remember that even in a lot of the UK stocks you hold, maybe up to 70% of the income is derived overseas. So the UK isn't such a big player. It will affect the UK, but we do want, just for stability everywhere, Sunak to be a trusted pair of hands, and he's not looking at the turnaround with COP, the sacking of Williamson, the problems with Braverman. It's not a good start.
Okay, so that's the global markets, or the economy news. The thing we're going to talk about today is pensions, different type of pensions, and in particular frozen pension pots. So let's start it off for those that don't know. Obviously, most people are also enrolled in a workplace pension nowadays. In terms of different types of pensions, I know there's a couple. I know it's quite a lot, but there's a couple of main ones. I didn't know if we started off by just sort of outlining the main two pension types there are and what the differences are, etc.
So let's start with the best type of pension there is, which is a defined benefit scheme, which don't really exist that much anymore, and that's where you go to work for an employer, and your pension would be based on the years of service. They are fantastic ways for people to save in pensions, but it became very expensive for employers because they were investing the money, not necessarily doing great with the investments, finding a black hole that there wasn't enough to pay these pensions, and having to dig into company profits and reserves to support them. So they are most companies now are moving over to a defined contribution scheme, which is you invest your money, and the amount you get back totally depends on the investment returns that you get, and that's why investment returns are so important and good advice is important. But that's the same whether it be a workplace pension or a private pension. But so most schemes are that way now.
Okay, so most people, if they're auto-enrolled, Josh, so again, Steve talks about defined benefit and contributions. Most people is a wrong statement, but a lot of people now will have the defined contribution type, which is the type that obviously they pay into a certain amount of per month, and their employer puts in some percentage as well. Is that the one that most people will have?
Yeah, that's the vast majority of pensions nowadays. The percentage that goes in depends on your employer. Some offer matching contribution, some only do the minimum. So it all really depends on the scheme that you're involved in.
So the defined contribution setup seems very good in terms of the fact that it ensures people have a pension for later in life. However, there is some drawbacks to it, and I know you've got some figures, Josh, you want to talk about this. The problem with these pension pots can be is when you change jobs, you work there maybe 5-6 years, you've been doing your defined contributions, you've been putting your pension contributions per month, you move jobs, and you may lose track of that pension, and etc. So that's a real, and that's the topic we're doing today about the billions of pounds that's missing. Just give us a little bit of the size of that and the problems it causes.
It's a huge problem. Any clients of mine will know that I've been saying this for quite a while. In the last few years, I've been saying it's a big issue, and I'd say in the last 12 months, I've started seeing more news outlets pick it up as an issue. But the statistics that have come up recently is the number of lost pension pots has risen by almost 75% in the last 4 years, and is now over £26 billion.
So there's £26 billion of money that's not been claimed, that's sitting there somewhere, that belongs to people that they've just lost track of.
Exactly, and they're saying the average pot is worth around £9,500, which is a considerable amount of money.
Which would help someone's contributions, Steve. That would help someone's pension pot if you could find that. I mean, £26 billion. I don't think people comprehend how big that number is.
Well, it's half of the government's black hole, and it really is. It's astonishing money. But what happens? People are just apathetic. They have pensions, they leave, they move jobs, they leave. 10 years, 15 years later, they've lost track, they've moved address, nobody can track them, the money gets lost.
Mm-hmm. I had a client that left a job, I think it was 3.5 years ago. She couldn't find the pension pot. We used the government website, she called up our old company, they wouldn't give it to her. She then she thought it could be one of 6 different pension companies. She called up each one individual to find out if they had anything under her name. On the 6th attempt, she found someone.
Wow.
That was only 3.5 years ago. Imagine what it's going to be like in 35 years when these companies sell, merge, change their name.
And that's the thing, because this auto-enrolment hasn't been around for that long in terms of, it's been around for a while, the defined contributions, but it's relatively short in compared to, say, the state pension or defined benefits.
But there have been these schemes run by employers going back, even defined contributions, they've been run for 20, 30 years. So there are pots going back 10, 20 years that people have lost, and so this is historical, and obviously the longer time the pot has been left, the more money that's in it.
Yeah, so it's £26 billion now. Like you say, Josh, roll on 30 years' time. How big is that black hole going to be?
Was Josh said 70% increase, was it?
75% in the last 4 years.
So it goes up another 75%. We're up to over 40 million of lost money. Now, this is something that is going way under the radar. Now, let me say I'm cynical, but why do pension companies want to let you know this is happening? Because they keep the money.
Mm-hmm.
And it's not something that people out there are necessarily encouraged to do, although there are adverts from companies now starting to pick up on this. I think the big question is, what should somebody do? Well, it's very simple. If you have historically, or if you've not been in the one job, or you're not fully self-employed, get a review done of your past pensions. Get somebody to look at it. Now, we're able to do it. If you have a financial advisor and you think they're competent enough, get them to do it. But it's a case, it doesn't cost any money to go and get those pensions. We do that service free of charge to go and get all the information for you. So we can, if you've got old pensions, we can get them, give you a report on them, and then help you decide what to do with them. But it's very important that you don't just sit there and do nothing.
And that's the issue with the pension. It's not just the fact of missing pension pots, it's also what it's invested in. And we'll come to cover that in a moment. So in terms of people who had previous jobs, they need to keep their pension information, the ones they're in, aren't they? And if they have if you have changed jobs recently, a few years ago, 10 years ago, whatever, like Steve said, get in contact and we can try and review and put them together. Talking about the pension pots, as I said there, a lot of these people don't know what they're invested in either. And I don't know whether you can just touch on why that's important. And obviously some of these pensions have charges, etc., and so I just wanted to make it clear to everybody why it's important to be invested in the right thing and the right attitude to risk.
Yeah, with your pension pots, they usually go into a strategic fund that, as you get closer to retirement, it starts to de-risk. However, it doesn't suit your risk profile potentially now. So one of our main jobs is to make sure whatever your money's invested in fits your attitude to risk profile. You're happy with it. You can deal with the volatility involved with that class of risk. Because otherwise, you don't really know what's happening. And a lot of the time, they're in these own pension companies' funds, and they might not perform to how you want it. So it's all about making sure it's in the right attitude to risk, in the right fund, getting the growth that you need to retire happy, and growth is such an important factor.
And it's a point of, it's not just taking too little risk, it's also you could be taking too much risk. You might be in a fund that's taking too much risk, you're putting too much of your money, taking a higher, volatility than you're comfortable with. And Steve, how important is it for the fund performance? Because we know some of the fund performance don't perform very well.
Well, let me just say, I'll use one of the Scottish companies, I'm not going to give the name. They tend to do a lot of defined contribution schemes, and they tend to default put clients into two funds. Now, one of these funds is middle of the road risk. It is showing a loss over the last 5 years, and this has a vast amount of clients' money in it. And to lose money in the last 5 years, it has to be pretty bad. And a lot of people, and I haven't done the number on how big the fund is, but I think it's in the region of 1,000 billion or something. And it's got clients all around the country losing money over 5 years. Now, let's just say you're in a middle of the road fund over the last 5 years. The least you'd expect in the last 5 years is 25 or 30% return. And that's even allowing for this year's crash, and that would be a reasonable expectation. There's more, and that's just the middle of the road. And to be showing a loss is pretty bad. So people that have got historical pensions, and there'll be a lot of historical pensions in these particular funds, are sitting there, and not only are they not tracking them, they're also losing money.
So again, coming back on what we said, it's really important for people to understand where their pensions are, what they're invested in, and understand the charges that go against it. Josh, I don't know if you had more. I know you got some more information there about obviously this pension black hole in terms of, we sort of skipped on to a bit, but I know that this is something that's close to both of you in terms of it's such a big problem. So I don't know if you've got anything else there you want to add to after your extensive notes and your research.
It's just the other fact is the government figures. They estimate there's £400 million in unclaimed pension savings, and what I assume that leads to is people that are in retirement haven't accessed this money and it's just been sitting there for the last few years.
So state pension, as in people haven't.
No, but lost personal pensions that they're in retirement, and there's £400 million sitting there unclaimed.
And that's not including the 26 billion that's missing as well.
They're two different studies, so I wouldn't be able to say.
They would
for
be
sure.
separate.
Wow.
So that means people that have come to retirement, the retirement's come, they haven't claimed it, haven't done anything with it, and haven't moved it, so they obviously may not be aware it's there. So this is stuff that's, the study I understand is the missing pensions are the money pre-retirement, and this is post-retirement. So you've got issues where that money then becomes into the post-retirement study, but whatever it is, it's an almighty amount of money that people are losing by not being on top of their pensions.
And people may assume that because it's registered their pension, they can always find it. But over time, that figure really shows that it can be lost.
What about the example where somebody very close to us, who we know, went and looked, got a statement, how many years ago was it yesterday? Was it 20 years ago or 30 years ago? Went to the company, was it 20 years ago, John?
40 years ago.
Well, it's got a statement, found it, went to the company, and the company said, we can't find it.
That's crazy.
And basically trying to say, oh, well, don't worry about it. That's not going to happen. She now has to say, prove you haven't got it, and where did it go? But that company, because what happens is all these companies start to merge, and they lose track. So you've got to be on the ball. There's people, literally, you can see how it gets lost because companies go around and bulk buy other companies who bulk, and then they sell on and they sell on. There's more of that going on, and these pots just get lost if you're not careful. You need to know what to do and how to store it, and this is what we help people in. I think over the next 5 years, it will be probably the most major part of our business is actually making sure that people's pensions are safe, secure, and invested correctly. I think this will become a much bigger thing for our business, and Josh has always said that since he qualified, that he thinks this will be the big part of the business.
So the advice, everybody, get hold of your pension pots. Any companies that you've spoke to, you need to try and get as many statements as you can.
Yeah, and biggest advice I can do is not think, we'll do that and deal with that in the future. As you say, it can change quickly. You can lose paperwork. It's something that it needs managing ongoing. As soon as you leave your job, you need to get the information. You need to store it. You speak to us. We can help you. But it's definitely not something to leave and, we'll do that in a few years' time, because it can change and be really hard to track down.
And like I said, that's a big number to prove how they can get lost and paperwork can be misplaced.
And it's going to get bigger and bigger and bigger, because my generation changed jobs a lot more often than people of previous generations.
So there are going to be lots of little pots around.
Exactly.
And like you say, if you said that average pot is £9,500, if you've got one or two of those, that's a big difference to your pension pots and your retirement, isn't it?
Exactly.
In terms of, and pensions are relevant at the moment, I just want to touch on advice from the pair of you at the moment. With the cost of living crisis, money's getting tight for people. Pension contributions is one of the things that people are potentially stopping to try and think. And I just want to know your advice on, not advice, but your views on that and how detrimental that can be.
Well, in terms of if you are, even one of these, government schemes, the employer, the 5+3s, which is where the standard one is that you put 5% in and the employer gives you 3. By not putting the 5 in, which is 4 after tax, you're losing, obviously, a vast amount of money. You're losing 7% of your salary going into a pension, and it's only actually costing you 4. So it really should be last resort of last resorts. You need to stop everything else first. A pension where you're getting free employer money is a no-brainer for most people to do that. So we really think that there should be other ways of looking at how to cost save. Now, something else that I've done in the past is I've sat with clients over my time and gone through their overhead, their outgoings, and I've been able to show clients how to save lots of money personally in different ways. So if you do have a client, if there's people out there who want to help, then Josh will be able to help them with that. This is something you help when you're building up your client base, in showing people how to look at their budget and save them lots of money. We'll be able to help them with that. So if people need that, we'll do it, but don't start stopping pension contributions.
Okay, well, I think that covers most of the things we want to cover on the plan mentioned. Again, if you want a review of your pensions, please get in contact with us and we can go through and do that. It's really important you understand, as Josh and Steve alluded to, you get hold of these as early as possible, because this pot and this black hole is going to get bigger and bigger. If you want anything you want to be talked about, please comment below, send an email in, info@goodwin-financial.co.uk, and we'll try and cover as many different topics that you'd like to be discussed here, and we will join you again next week. Gentlemen, thank you very much, and we'll bring you the episode next week.
Thanks, Kev.